Hey everybody, Smart Silver Stacker here. Let's talk about how the global financial system has transformed into a giant confidence game, and it's one that we might be seeing the end of in the relatively near future. But before we get into all of that, I do just want to let you know that I've partnered up with SD Bullion, and in today's video, we're going to be giving away two 5-ounce Proclaim Liberty silver bars. So if you want to know how you can enter for a chance to win those, stick around to the end of the video. But I will just let you know that there's going to be a Morgan dollar just like this one popping up on your screen at some point in this video. And in order to enter to win, you're going to need to know the year that is minted on that coin. So jot it down when you see it. Now, early Tuesday morning, the Financial Times published this headline: Bank of England set to further delay sales of government bonds until markets calm. And this quantitative tightening, this sale of UK bonds from the Bank of England's balance sheet, was originally scheduled to begin on October 6th. Of course, on October 6th, the bank was already involved in their emergency bailout of the UK bond market. They were doing emergency quantitative easing. Didn't make a lot of sense to start quantitative tightening at that point, so they pushed back the date to October 31st. And this headline is claiming that they've pushed it back once again. But it turns out that that wasn't the case. The Bank of England quickly issued this reply where they said that this report is false and they have not reached a decision to delay the sales of bonds. And then the latest update is that the Bank of England has announced they are going to proceed with the sales on November 1st, but they're not going to sell the longer dated gilts. Those are the ones that suffered the most in the recent bond market crash, the crash that forced the bank to intervene. And so there was at least an element of truth to that report from the Financial Times. And I had forecast in a video that I put out a couple weeks ago that the Bank of England would delay this planned program of quantitative tightening, pointing out that it's a little crazy to be doing emergency intervention in the bond market up until October 14th, and then expect that in 2 weeks' time, the situation will have normalized to the point where you can actually begin selling bonds onto the market rather than purchasing them. And a lot can happen between now and November 1st, and honestly, I would not be surprised if we still see the bank end up pushing these sales off. You know, if we see a resumption in the sell-off in the gilt market, if we see yields spike up, and they're already significantly higher than they were before that intervention. So, you know, the risk is there, and it would not shock me at all if we see this get delayed. And of course, that makes the optics even worse if they keep pushing these back. And that is the reason that it's risky either way, regardless of what the Bank of England decides to do, because these emergency interventions, they're already a double-edged sword. I mean, sure, they can stabilize a crashing bond market, but they also risk destabilizing markets further by removing confidence. And in today's system, confidence is everything. I mean, this whole thing is really a big confidence game. Debt markets, they're kind of like a Ponzi scheme. And when do Ponzi schemes fail? Well, it's when confidence is lost and too many investors head for the exits at the same time. And also, these conflicting reports, you know, getting a major news outlet like the Financial Times saying one thing and the Bank of England saying another, that also undermines confidence among investors in a pretty significant way. So it's becoming a bit of a tightrope for these central banks. You know, on one hand, they have to behave as though everything is fine, but then simultaneously they have to be ready to intervene with a surge of liquidity at a moment's notice because they know that the cracks in the system are starting to show. And they also have to be very careful with everything that they say and how they manage the perception surrounding these interventions, because if they slip up and investors get wind that a major crisis is brewing, that could become a self-fulfilling prophecy and trigger a cascading sell-off that's going to require even further interventions. So they have to be very careful with how they deploy these emergency measures. And I suspect that that has something to do with this program of debt buybacks that Janet Yellen is proposing at the Treasury. First, back on October 12th, Janet Yellen voiced concerns about a loss of adequate liquidity in treasuries, and she's the Secretary of the Treasury, former chair of the Federal Reserve, and it seems like it's just dawning on her that there's a liquidity problem, but this has been brewing for a long time. I mean, this crisis has been years in the making, and she just seems to be just catching wind of this. And then a couple days later, she floated this idea of the Treasury buying back some issues of U.S. debt, the older, less liquid bonds, and that would allow the Treasury to sell the newer, more liquid issues more easily. And, you know, she says this is not quantitative easing, it's not quantitative tightening, it's something completely different. But To me, debt monetization by any other name is still just debt monetization. And of course, this is sort of a pretty standard procedure these days. If you want inflation to mean rising prices instead of an expansion of the money supply, well, you just change the dictionaries. And if you don't want to be in a recession, well, you just change the goalposts. And if you want to get away with monetizing a bunch of debt while simultaneously paying lip service to the idea of fighting inflation, well, just call it something else. Don't call it quantitative easing. But again, the reason that they need to come in with this stealth form of intervention and not call it quantitative easing is because if they were to announce further quantitative easing, that would significantly undermine investor confidence. So they've got to try to get in there and intervene and prop up these shaky markets, but at the same time, they've got to be very careful about how they do it. And this mechanism by which the Treasury buys back bonds, we are likely to see it implemented in the near future. Bank of America strategists are now forecasting a May 2023 rollout for this mechanism. So this is going to go into effect, although, I don't know if May of 2023 is going to be early enough to intervene before we get some kind of a blow-up debt crisis here in the U.S. markets. And, when you're considering the merits of this idea and Janet Yellen's leadership here, take a look at this clip that I posted in a video back on October 13th of 2021. This is Janet Yellen's congressional testimony, and it's some of her thoughts on the debt market.
One, in thinking about what is a reasonable level of debt, there are a number of different metrics that one might look at. Commonly, debt to GDP ratios are a measure that's widely used. Ours is a little bit over 100%, which traditionally has been regarded as high. But we are in a very low interest rate environment that's been true for a very long time and is likely to be true going forward. And an alternative and I think better measure of fiscal sustainability is to look at the real net interest cost of the debt. What is it in real terms costing to service the outstanding debt? And for the last several years, that's been negative. And even if interest rates, 10-year rates and the Treasury yields revert in future years back up to more normal levels, the interest cost, which really is the burden, is projected to remain low.
So how's that low interest rate environment working out now? Forgive me if I am just a tad skeptical of Yellen's ability to accurately forecast this looming debt crisis and to safely steer us through it. All of these emergency interventions, these mixed signals that we're getting, this rising uncertainty, these new mechanisms of intervention that are being unveiled, what it all ultimately means is that this confidence game is nearing its end. When exactly, who knows, but at some point yet to be determined, the global debt bubble is going to pop. It's only a matter of time. And that's when there's going to be a payoff for everyone holding physical, tangible assets like gold and silver. Now, don't get me wrong, I'd prefer that the debt market not blow up and the dollar maintain its purchasing power and inflation just go away. But that's just not really reality as I see it. And so the next best thing to avoid being wiped out entirely in this collapse is to hold some tangible assets. Gold and silver remain, in my view, the most undervalued assets out there. You just look at any historic ratios, the Dow to gold ratio, the silver to gold ratio, the growth of the money supply versus mining production. All of it indicates that today's prices for precious metals, especially silver, are absurdly low. Now, why is that? Well, there does seem to be a concerted effort to hoodwink the public. Inflation has been redefined, recession has been redefined. Honest money has been taken out of our currency. It's been replaced with nickel-plated copper counterfeits. And why do they plate the coins with nickel? It's to make them look like real money, like silver, because it's all sort of a big psyop to get the public into fiat currency compliance mode. And we're getting to the point now where unless you're 50 some odd years old, you've known nothing but a global fiat currency standard for your whole life. And the effects of this are starting to show. Just ask the average person on the street that you bump into about fiat currency, hard money, gold, silver, the fact that the US has $31 trillion in debt. For the vast majority of people, none of this is on their radar at all. Stackers, we're in the tiny, tiny minority of people who are holding hard assets. And I think we're going to benefit disproportionately as a result of that when the debt bubble does pop. We just hit $31 trillion in debt. And, we're well on our way to 32 already. Spending's out of control, debt service is out of control, and with rising rates, that's just going to get worse. And with a debt of this magnitude, it's just not payable. You can't get that much out of the population with taxes. So there's only two options. You've got to default, or you can default by another name, which is hyperinflation, just paying off the debt with devalued dollars. And not only is this debt unpayable, but the real pickle is that we can't finance all of the spending that we have via borrowing forever. It's just not mathematically possible. It's remarkable how long this has been able to go on like it has, but eventually something has got to give. You've already got these burdensome debt levels. That slows down economic growth, makes your GDP shrink, and then your debt to GDP ratio explodes. You've got a declining tax base to finance the payments on the debt. And on top of that, inflation is getting out of control. So what are central banks doing? Well, they're raising rates. And that's just going to increase the cost of servicing this debt. So more debt is accumulating more rapidly. And don't forget, you're getting less taxes. So what does the government do? Well, they hire 87,000 IRS agents to try to squeeze more blood out of a stone, out of the American people via taxation. And that just hurts economic growth even further. It's all kind of a downward spiral. You see the economy withering, you see inflation and debt getting completely out of control, and governments and central banks, they're just doubling down on these failed policies until the bitter end. But there is still some good news, and that's that there's still time to get prepared and to get into hard assets. But for those of us holding metals, it's going to require some patience because precious metals are likely to remain undervalued until this system goes into a terminal spiral. But once that happens, it will be too late to stack. Physical bullion will be very hard to come by once the debt bubble pops, at least for a period of time. And since I have no idea when that is going to happen, only that it is a mathematical inevitability, I prefer to just dollar cost average, buy the dips in the metals when the price comes down. And, of course, none of this is financial advice. I'm not a financial advisor. I'm just telling you my thoughts and what I'm doing. But what's better than buying silver? Winning it. So if you've been waiting patiently to hear about how you can win one of those 5-ounce Proclaim Liberty silver bars from SD Bullion that I mentioned earlier, the wait is over. And first of all, this giveaway is limited to US viewers over the age of 18. It's very simple to get entered for a chance to win. All you have to do is first, smash that like button down below. Second, if you're not already subscribed, subscribe to the channel. And then remember that Morgan dollar that I mentioned at the beginning of the video? Well, if you watched all the way through, I hope you jotted down the year on that coin. Because to enter to win, what you need to do is leave a comment on this video. And in that comment, make sure to include the year of that coin somewhere in the comment. For example, if the year was 2022, put the number 2022 in the comment. Don't spell it out, just put the numbers. And of course, it's not 2022. Use the number that was on that Morgan dollar, because this Friday, I'm going to post a video where I randomly select 2 winners from the comments, but I'm going to be filtering out only comments that contain that year. And also, I will be filtering out any duplicate entries, so it's just 1 entry per person. And when I do that drawing, I'm going to disable the comments on this video. So if you can still leave a comment, you can still enter for a chance to win. And also, stay tuned for that video where I draw and announce the winners, because you'll need to get in touch with me within a few business days to claim your prize. Otherwise, an alternate winner is going to get it. So that's all for today, everybody. Thank you very much for watching. I will catch you next time. Smart Silver Stacker, out.